You ever stop and think about how that thing you ordered online gets from a factory on the other side of the planet all the way to your front door? It's this incredibly complex dance of ships, planes, and trucks. Well, today, we're diving into the world of global logistics to look at a company that's found a really unique way to be the choreographer of that dance, Radiant Logistics. Okay, let's get into it. All right, here's the plan. We'll kick things off by breaking down their unique business model. Then we'll see how that actually makes them money and look at their pretty aggressive growth strategy. After that, we'll crunch the numbers, talk about the risks they're facing, and wrap up with what management sees coming down the road. So, in an industry filled with giants, what exactly makes Radiant so different? Well, it all boils down to a business model that's built on flexibility, not ownership. This right here, this is the world Radiant lives in. The biggest challenge for anyone in this business is figuring out how to move stuff through this massive global web as efficiently as possible. Now, the old school way to do it, you own everything, the trucks, the planes, the warehouses. But that is incredibly expensive. We're talking huge amounts of capital tied up in assets. Radiant looked at that and said, nah, we're going to play this game a little differently. They're what's called a non-asset-based logistics provider. The easiest way to think about it is like this. They're kind of the Airbnb of shipping. Airbnb connects you with a place to stay, but it doesn't actually own the hotels, right? Same idea here. Radiant connects customers who need to ship stuff with the carriers who own the trucks and planes, but Radiant itself doesn't own the fleet. They are the master coordinators, the ultimate middleman. Now sure, the trade-off is maybe a little less direct control, but for them, the flexibility is everything. And this slide just lays it all out side by side. On the one side, you've got the traditional guys who are asset-heavy and weighed down by the massive costs of owning and maintaining all their gear. And on the other, you have Radiant's model, which is just way more agile. It's flexible, it can scale up or down really easily, and it has way lower risk because they don't have all those massive fixed costs sitting on their books. And this is their secret sauce. They build and manage this huge network of what they call strategic operating partners. Think of these as independent agents out in the field. They get to do what they do best, sales and operations, while Radiant gives them the brand, the tech, the global network, and takes care of all the back office headaches. It's this really powerful win-win relationship that gives Radiant an incredible reach without the massive overhead. Okay, so this non-asset-based model is clever for sure, but how does it actually make money? Well, it's all about being that essential connection point in the middle of the network. And you can see it right here. The vast majority of their revenue, a whopping 94%, comes from their main gig, arranging transportation. That other little 6% slice comes from extra services, things like customs brokerage and warehousing. It really shows you where their focus is, on being the best coordinator out there. So let's trace the money. Radiant goes and buys space from the actual carriers, the shipping lines, the airlines, you name it. Then, they turn around and resell that space to their customers, obviously at a profit. At the same time, they provide all that central support for their partners, who are the ones out there hustling to find customers. Radiant just sits in the middle, making the whole thing work and taking their cut. Now, a network this big doesn't just pop up overnight. A huge piece of Radiant's strategy, really from day one, has been to grow by buying up smaller, established logistics companies and just plugging them right into their system. And this timeline just shows you how methodical they've been about it. You can see a clear pattern here. They buy companies to either get into a new country or to add a new skill to their tool belt. The Wheels Group deal in 2015, for example, made them a huge player up in Canada. And that 2021 acquisition of Navegate, that was a big one. It didn't just give them a presence in China, it brought in a really sophisticated tech platform that supercharged their whole supply chain operation. Which brings us to their latest big move, the acquisition of Weport down in Mexico. This is a massive strategic play. It basically gives them full coverage across a key North American market for everything from air and sea freight to customs. It's just another perfect puzzle piece to strengthen their footprint across the continent. All right, so how does all this strategy actually look on the balance sheet? What's really interesting is that the company's own report says they pulled off these results in a challenged market, which makes the numbers we're about to look at even more impressive. First up, the top line. Radiant brought in over $900 million in revenue. That's a solid 12.5% jump from the year before. I mean, that's pretty impressive growth, especially when you consider how tough the global shipping market has been lately. But here's where it gets really interesting. It's not just that they're making more money, they're getting way more profitable. Their net income more than doubled, jumping from 7.7 million all the way up to 17.3 million. That tells you their lean and mean model isn't just growing, it's getting more and more efficient. So, how did the market feel about all this? Well, this chart puts their stock performance in perspective. It shows how they've stacked up against both their direct competitors in the transportation sector and the broader small cap market over the last 5 years. It's a great snapshot of how investors have been valuing their story. But, of course, it's not all smooth sailing. No business is without its challenges. So, to get the full picture, we have to look at the risks that Radiant itself has put on the radar. A few key things really stand out. First, their greatest strength, that partner network, can also be a risk. You got to keep all those independent agents happy. Second, their whole growth strategy depends on buying other companies, and there's a ton of competition for the good ones. Third, being global means you're exposed to everything from trade wars to cyber attacks. And finally, remember they're the middleman. If the carriers jack up their prices, Radiant either has to pass that cost on or watch their own profits get squeezed. So, with all that in mind, what's the game plan? Where does the company's leadership see things going from here? Let's take a look. This quote from their annual report pretty much sums up their whole vibe. They're feeling confident. Despite a tough market, they believe they're in a great spot with a proven model, a healthy bank account, and they are ready to keep on growing. And here's their strategy, broken down first. Keep growing the main business and making their tech even better. Second, keep the wallet open for more smart acquisitions, but also buy back some of their own stock. And finally, invest in their people and in sustainability. It's a really balanced plan: growth, efficiency, and responsibility all rolled into one. And all that brings us to the big question at the end of the day. There's no doubt Radiant has built a lean, mean, money-making machine, a network that's great at delivering goods and profits. But as the world gets more and more unpredictable, is their flexible model and their appetite for acquisitions going to be enough to navigate whatever storms are ahead? That is the multi-million-dollar question.